food for thought, right? Now, but what does it say? It says, listen, fundamentals do matter. That whole mantra, as David Tepper pointed out last week, don't fight the Federal Reserve, matters. And you know what else matters? Earnings and valuations in this environment. I think that's what the market is trying to figure out. And I'm glad you mentioned that Nasdaq level, one that Dan's brought up a number of times. I think it's 9,800-ish, where we broke down from in February of 2020, obviously when COVID hit. And by golly, it sure looks like there's a bullseye right on that level.
Wow. You think we go to, I mean, Dan, you still think that level is the level to watch? That's 400 points from where we are now-ish?
Yeah, I think, Mel, that there's a really good chance that the S&P and the Nasdaq retrace those entire moves back to its pre-pandemic levels, or the highs in February 2020, and Guy just mentioned the level there. I think the fact that the Nasdaq 100 made a new 52-week low today, which is, I guess we saw this massive rotation from mid-October to value and some bit more defensive sort of names and out of some of the higher valuation sort of stocks. And I think it's really interesting that it also happens to coincide with the move that we had in yields, right? So we saw the 10-year U.S. Treasury yield about a month and a half ago top out, and that gave a little air, I think, to some of those sorts of tech names that have been beaten up so badly. And you got to go back an entire year, right, when the Fed pivoted and said that they were going to start raising rates aggressively to battle inflation. That was kind of the last, that was the last call for a lot of these high valuation tech stocks that were going to see deceleration in a lot of their growth metrics that had been pulled forward in the back half of 2020 and all of 2021. So it feels like it's kind of a bookend to this period that we've been in over the last 3 years now, Mel.
I mean, it feels like rates are on a trajectory higher with, Japan now throwing in the towel. We've gone up 40 basis points in just the past 3 weeks or so, Guy. So that, of course, is the headwind for tech stocks that Dan was talking about. But then you also have layered on the reopening of China. And everybody thought the reopening of China would be a great thing, not thinking that China was going to rip the Band-Aid off and spread COVID all over the country in a rampant fashion. In a way that puts supply chains, puts factory production at risk once again.
I heard you posit that this morning at approximately, I think, 7:15 during your wonderful 3-hour performance on Squawk Box, and that's exactly right. I mean, think about what will that do to the inflation problems. And again, rates going higher in this environment should theoretically mean the economy is getting better. It does not mean that at all. So you have rates going higher once again. Volatility in the bond market seems to be back. Not particularly healthy environment, in my opinion. And I'll just sort of layer this on to Dan's point. You look at names like NVIDIA, which traded down to 108, I believe, on October 21st. I'm probably off by a couple days. Subsequently rallied in a month and a half, over 70%, and now it's given back effectively half that move. I mean, think about a volatile name like that, and that's so interest rate and market sensitive. That's the environment that we find ourselves in. So rates going higher, again, my opinion, in this environment is not any sign of growing growth. It's a sign of continued concern on the inflation front.